CPAs and consultants, CPA Rick Schefferly. Hi, Rick.
Hi, Bart. Welcome.
Good to see you.
It's good to see you too. Thank you for the invite. It's great to get out here. Tax season's winding down, and I guess we thought we'd give a few last-minute tips and ideas and suggestions for the individuals that are out there that still have not filed their returns.
Perfect. So, do we have any idea, percentage-wise, of how many people are still unfiled?
If we look at our office, probably in the last 3 weeks of tax season, I bet we pushed through maybe 30% of our 1040s. And a lot of that's just due to individuals that are in Florida. There's a lot of people that are wintering down there, and they're coming back from spring break, and they're making it a motivation to bring their stuff in now. Some of it they're waiting for K1s, and then some of them, the brokerage statements that still come in late a little bit, and some of them are getting amended. So there's a little bit of compression at the end of probably from the 15th of March to April 15th to get the individual returns done.
So if people aren't going to make the April 15th deadline, what are the extension options?
Yeah, if they're not going to make the 15th deadline, they can extend. There's a form, it's a 4868 that needs to get filed. And a lot of individuals think that when they extend their tax return, that provides them time to make the payment if they owe money. And that really isn't true. You really need to have a good idea and understanding where the taxes are sitting as of April 15th. And if you do owe money, you need to have those checks written in then. And it is not an extension of time to pay. The other thing that comes with that is your first quarter estimates are also due the 15th of April. And if your tax return's not done, it makes it difficult to determine what those first quarter estimates could be, maybe the second quarter, depending on the individuals. So we always take an approach sometimes with the clients that we know are going to have larger estimates. Maybe we load up the extension payment so we get enough in there to cover that first quarter estimate. Or if we miss where we think they're going to be, or they miss something from a perspective on the tax return, we have plenty of tax paid in to cover it. So sometimes we'll load that first quarter payment in with the extension so we get it covered.
How liberal is the IRS when it comes to people guesstimating what their taxes might be?
They got to be close. I mean, you really want to try to hit it close from a perspective. So I think you really have to sit down and go through all the motion. You can't get lazy at the end and say, I think it's going to be this. We almost need to do a dry run through the tax return to get everything in, figure out where they're at, and then we'll take kind of an estimate of what we're missing, because some clients have publicly traded K1s, and we don't see those sometimes until almost September. So it makes it very challenging to get first and second quarter estimates right when we really don't even know as of April 15th what their income is. It's just basically an estimate.
What are safe harbor estimates?
So really, the clients that are required to pay estimates are ones that probably don't cover it with their withholdings. And we have some clients that refuse to pay estimates, so they'll adjust their W-4 and bump up their withholdings to kind of cover that so they don't have to pay estimates. But basically, a client has a couple of different options when it comes to if they owe tax or if they're going to owe tax and they're short on their withholdings. The typical approach we take is 110% of their prior year tax, and that's paid in quarterly. And what that does is it safe harbors them from penalties and interest from the IRS. And unfortunately, sometimes that doesn't always work, and we've had some instances this year where maybe the client messes around with their withholdings, so they drop their withholdings number down, and the software looks at it and says, well, you had $10,000 last year, Bart, of federal withholdings, so it assumes you're going to have $10,000 this year, and then it does an estimate to cover that shortfall that we owe. Well, if your withholdings goes down, the estimates are going to be light, and when that happens, they do get penalized some. And usually those ones aren't terrible. I had one the other day that I think their withholdings went down by about $3,500, and they didn't really understand why. So I don't know if they did something or it's just the way the cards fell, but at the end of the day, I think it was about a $300 penalty, which taxes are bad enough. We don't really want to give the IRS any extra money if we can avoid it, but it just pays to kind of pay attention to that from that perspective. And then one technique, if you do think you're going to be light, because some people don't estimate, maybe they start out slow in the year and they think they're not going to have as good a year, and that fourth quarter really lights up, or the third and fourth quarter, you can bump your withholdings up, and that would take care of some of that shortfall. And we have had an instance with a client that was short, and he took some money out of an IRA, withheld tax, and then treated it as a loan and paid it back, but the tax got paid in that way. And it's a little trickier, a little more time consuming, but it'd be a lot easier just to get the estimates paid timely and not have to worry about that.
So you say we don't want to give the IRS more than we need to, but what do you think about having your refund banked for future liability?
Yeah, that's a great question, Bart. I chatted with a client this morning that was $6,000 overpaid, and it's really funny sometimes clients will look at it and they will say, no, we're good, we'll take the money back, we'll make the payments, and then they don't make them. And some clients look at it with interest rates are still, 3.5% to 4%. They're okay leaving the money in there from a perspective. So we'll usually give that client that option. I mean, they would probably get their first quarter back probably within, I'm hoping 4 weeks probably. So now you're into May, so you want to cover, at least the first quarter, and then maybe look at covering second quarter. The client this morning took the option, they wanted to cover the whole year, so they didn't have to worry about making any estimated payments. One of the things we do with some individuals, like if they have a smaller estimate, maybe it's $500 a quarter, we'll have a discussion with them and maybe we front load that all into one quarter and we'll say, let's just pay $2,000 and we'll pay it out of the gate. That way you don't have to worry about it all year, and if you miss one or you're late, it doesn't matter, and it's in, and you can kind of just, I guess, mail it in and forget it.
Little peace of mind.
Yeah, it is.
All right, so let's say April 15th, you've got a file, you owe money,
Yeah.
you don't have the money.
Yeah.
Are there some options the IRS offers?
There are options. The IRS will offer an installment agreement. It's a 9465. One of the things I didn't realize back in the day, and I had a client that had a little bit of an issue with it, there is a fee for that installment agreement. And it depends if you file that installment agreement online, and it depends on how much money it is. So there's a lot of what ifs. And then they do charge you interest, and that client was very surprised that they charged them interest. And I thought, really? I mean, the IRS is not going to give you an interest-free loan. But the fee's nominal, and if you really don't have any options, like some people can pay with their credit card, they don't have that option. Some people have family members they could borrow it from too. But if you don't have that option, you really want to go through that approach and get an installment agreement. And one of the tricky things, you're really only allowed to have one. So we have had some clients over the years where they get behind and then they get behind the next year and you're really stuck to one. And then we try to encourage them, instead of having an installment agreement with the state and with the feds, is try to get something where at least get the state paid. Usually that's a lot smaller number, and they're not very friendly either with their penalties. And if we can get that paid in and pay 100% of that, then we're only really dealing with the agreement with the feds, and we don't have the state chasing us too. So it makes it better from that perspective.
All right. Is there anything anyone can do now? Here it is. We're filing for 24. Any opportunities to save on taxes in these last couple of weeks?
Yeah, there are a few options. We had a client this morning, actually, we're working with a broker up in Lansing that he knows, and he had a really exceptional year on some Schedule C. So he's self-employed, he had a good year, and he wanted to put some money away in his retirement, and he's older, and a SEP plan was an option for him. And we reached out to the broker, who happened to be on a cruise, so it was a little bit tricky, but he got back. They're up today getting it set up, and I think we're putting north of $60,000 away for him right now, and it's going to save him, I can remember, maybe $17,000 in tax. So, but he wanted to put a little bit more money away and get it into his retirement, so it was a great option. And that plan wasn't in play before now. So your IRAs would be another one if you're eligible, and there's some rules that you have to have earned income, and or maybe you can borrow some off your spouse. You can use that, and it depends if you're in another plan someplace. But you can put some money away into a traditional IRA, which will save you money. The other option some people are looking at is the Roths, and going forward, and it's not all in play, but I think 2026 it's supposed to be, but there was a Secure Act change where us individuals that are over 50, obviously you can see my gray hair, so us individuals that are over 50, we pay that extra, we get that catch-up provision in our 401k or in our simple. Those will automatically be forced to be put through a Roth, so we'll get that ability to do that Roth. But depending on your income levels, and obviously ask your advisor, ask your CPA or whoever handles your tax stuff whether or not that's an option for you to make sure it works. But you could do a Roth, you could do a SEP, potentially if you have self-employment type income, and you could do a traditional IRA. And then the other side of it, if your health, I guess I want to say most health insurance plans seem to be high deductible today. Mm-hmm. And we have more and more people putting money away in HSA, so a health savings account, and that you have the ability to do till April 15th too. And for a family, and if you're over 50, I think it's $9,300. There's an extra $1,000 if you're over 50. We don't put away for that. So if you have a high deductible plan that qualifies, it's another $9,300 that you can put away. And the banks give you, I don't know, the ability to take that out for qualified medical expenses. So if you have, maybe you don't have dental in the office and you want to use it for dental, it's a great way to get a tax deduction and plan and get that in the last minute if you think you need an adjustment from that perspective.
All right, great advice. Couple weeks left to get those taxes in, and the folks at Willis and Jurasek, they'd be happy to help. Rick, good to see you.
Good seeing you. Thank you, everybody.
CPA Rick Schefferly from Willis and Jurasek. A lot more on the show today.